Let's welcome in Vibhav Kapoor, Group CIO at IL&FS. He's now joining us live. Mr. Kapoor, thank you so much for taking out time for us. Could you just tell us that yesterday, of course, there was a severe correction, and I know you don't look at daily basis. But, when markets rally this ways, whenever there is a correction, there'll always be the feeling among traders that, this is the top, just exit on your profits. And that's why you see such a sharp reaction every time markets go down?
Well, markets have been going up for such a long time, and they have gone up quite a bit. Valuations are a bit expensive. People are sitting on a lot of profits. So obviously you will have, intermittent profit taking, which leads to such type of falls whenever there is some, anxiety in the market for any reason, as it happened yesterday.
Right, and that actually makes the market healthy because, people who have conviction actually tend to hold on, and people who are scared are actually out of the market right now?
It does. That's the nature of the stock markets. You need corrections from time to time for it to become healthy. Otherwise, if the market if doesn't correct from time to time, then people are sitting on very large profits, and there is always that temptation to book those profits even at the slightest sort of cause or nervousness.
Right. What do you, when you talk to FIIs or your different clients, what is the sense that you get? You think that they're getting that left out feeling in the market, and that's why every decline they would use as an opportunity to buy?
I don't think it's a left out feeling. People, but there is a lot of money which is coming into equity markets. Now, this is for different reasons. Domestic money is coming in because of the SIPs, because of low interest rates, because nothing is happening in gold, nothing is happening in other, real estate is not going up. And the demonetization has had an impact of bringing a lot of, cash money into the system. So all these are reasons why there is so much of domestic money flowing in. Global money is flowing in because India is one is because the emerging markets are again back into vogue. The global liquidity is very high, interest rates are very low, and India obviously is in a better position because of political stability and the hope that the economy will grow faster. So all in all, there is a lot of liquidity which is coming into the Indian markets and leading up to this big rise.
Right. Overnight, we've seen some news flow regarding Brazil, regarding Venezuela, what could happen over there. Some bit of global jitters are seen overnight. What is the sense that you get? India still remains isolated, will continue to see inflows after a knee-jerk reaction to global markets?
Well, any country in the global context cannot remain completely isolated from global trends. That never happens. And India is one of the emerging markets, so it will have an impact, or it will be impacted by whatever happens in the emerging markets. But having said that, of course, as I said, India is in a strong position right now, so it will probably get disproportionate share of the emerging market pie. But if there were to be a lot of nervousness all over the world markets or the emerging markets, it cannot remain completely isolated.
Right. Just in terms of GST and the initial data that one has got, do you think that will add to the earnings of Nifty, or it could be a disruptor in the near term?
I don't think it is going to add, in the sense that the government also has an anti-profiteering clause, which means that if your tax rate has come down, then you have to pass it on to the consumer. But of course, better compliance, and we think that because of GST, there will be improvement in demand, particularly in companies and sectors and products where the tax rates are going down, which will lead an increase in volume over a period of time. So all these factors are definitely positive. Now, in the very short term, there may be some disruption because of, the whole system changing from the old system into the new GST system. But I don't think that's really important. So overall, there is no doubt that the GST is going to be a very big plus point for the markets. But obviously that will play out, over a 9 to 12 months period.
And do you think investors globally, here domestically, know that there will be these changes or disruption can happen because of changes? So they'll wait for FY19 numbers or impact after 6 months before they take a big call?
No, I don't think it's a question of taking a big call. GST has been in the pipeline for a pretty long time now. And the markets just keep on factoring everything in, as we know. In fact, the markets factored things in advance. So it's not as if, one night morning they're going to wake up and say, oh, GST is in there and therefore the markets are going to go up in a big way. That is already being factored into prices. So perhaps, for all you know, quite a bit of the improvement in the markets has been due to the fact that GST is coming in. So the markets continue to factor things in continuously, and unless it's a very surprise event which takes place, that discounting keeps on happening all the time.
Right. Earlier in the answer, you mentioned about liquidity and how essentially flows have been. Do you think most of the flows, whether it comes from domestics now or it comes from the FII side now, is a long-term fund? So earlier, there were short-term FII, DII players, but now the view has changed. Money which comes in has a stickiness or a nature of stickiness with it now?
I think in the domestic side, what you're saying is right. Hopefully, a lot of this money coming in will be sticky and will be long-term in nature. On the FII side, I don't think anything has changed. So there are all sorts of players there. There are long-only funds, there are pension funds who have a longer-term horizon, and there are hedge funds and short-term funds who have a short-term horizon. So that part of it, I don't think changes.
Right. Let's talk about some sectors and where essentially you expect growth to come in. So first about the Q4 numbers. So far from the banking, the NBFC side, what is the sense you get about the Q4 numbers?
I think they've been largely in line with expectations. At the beginning of the result season, we were expecting a 10 to 12% increase in profits for this quarter on a YOY basis, and I think we are in line for that. We should end up somewhere around 10%.
Right. And in terms of banking and financial, do you think that which has been leading the numbers so far will continue to lead the numbers on a YOY basis growth?
Well, the private sector banks and the NBFCs have been doing pretty well, but I'm not at all sort of impressed so far with the PSU bank numbers. There have been quite a lot of slippages. There is still a lot of pressure on bad assets. So I think that is going to take some time to improve.
Right, but private banks and NBFC results so far, again, one has to be selective because there are a lot of private banks also where you have seen a little bit of increase in slippages versus what was expected.
Yes, to I would say a limited extent, what you're saying is correct. So one certainly needs to keep a watch out for asset quality as far as the private sector banks are also concerned. Because we must remember that they are also part of the overall system, and therefore, that danger or risk is always there. They have managed it pretty well so far. You are right, a little bit of deterioration has been noticed in some of them in this quarter. So one definitely needs to keep a close eye or a close watch on this factor going forward.
Right, but the point that you made, that the environment is probably not the best for them to operate. Do you think that in such an environment, say, for example, if a company has a NPA or a gross NPA of less than about 2%, just historically they have been lesser than 2% or 1.5%. If it actually increases by 30-40 basis points due to one or two chunky accounts, investors would not get worried because the environment itself is such?
Well, as I said, you actually need to analyze each case, and you really need to keep a close watch and, you see whether there is a general deterioration is happening in the asset quality of a particular bank, institution, or it's just because of one or two chunky assets which can be one-off.
Right. Just in terms of PSU banks, you mentioned about you did not like the numbers overall. You think capital infusion at this valuations, probably this year or next year, will also take the valuations down? So what's happened for private banks on the positive side may actually not be that positive for these PSU banks?
Well, yeah, obviously if you do, infuse capital at below book value, that takes the numbers down. But the point is that, these banks need capital very, very badly. And so probably in one sense, capital is welcomed at any value, at any valuation. Because without further infusion of capital, these banks have a danger of really getting into bigger problems. Sometimes it's a question of, okay, you may be getting the capital at very expensive valuations in the opposite way, but you need it so badly that you just have no choice but to take it.
Right. What happens in the consumer durable space? Let's start with the durable space first. Do you think consumer durables, the recent valuation increase that one has seen, is factoring in the best of the growth going ahead?
Well, that's not only true for consumer durables. I think the whole market is factoring in a lot of growth going ahead in FY 18-19. And if you look at most analysts, notes or comments or whatever, you find they're all sort of discounting FY 19 already, not FY 18, but FY 19. And on a FY 18 basis, I think the market is somewhere around 20 times now. On an FY 19, it's somewhere around 17 times, after having factored in a 16 and 18% growth in earnings for the next 2 years. So what you're saying is not only true for consumers or consumer durables, but for the market at large.
Right. Vibhav, just request you to stay on. We have a listing that's happening today. Hudco is making its debut on the market, and it's 10 a.m. You should start getting the prices anytime soon. I think we're yet to see the prices, but okay, the trading has started. So it's at about 73.65 odd levels, 31 million shares traded. That's Hudco for you. That's the new listing which has happened. Going ahead in the show, you will hear from the management, and it's a company where there is a lot of interest. A lot of interest is there. Already 80 times is the sort of subscription that one saw, and now you're seeing this listing happening at about 13 to 14 rupees higher. Vibhav, for primary markets, do you expect that till the time markets don't correct or there is not a bearish phase in the market, good companies will come out with IPOs? Because that's essentially the time that most of these companies would want to use this opportunity to list at decent valuation when investor appetite is strong?
Of course, that's always one of the positives of a good stock market. That companies can raise money at good valuations, which helps them in their capital costs and funding their projects. Of late, we have seen the primary markets becoming more active. We've had actually pretty bad 2-3 years earlier for the primary markets, but now with the secondary markets doing much better, it's very obvious that the primary markets are also getting encouragement from that. We've seen some very good issues come out, and they've been well received in the market. So I think that will continue as long as the stock markets continue to do well, and that is always a very welcome feature as far as corporates are concerned.
Right. In terms of primary markets offering, the recent response that you have seen to some of these issues like Hudco, about 80 times. Previous issue saw some great amount of subscription. So a lot of interest from retail. HNI is coming back into this primary market, which was missing for years now.
Yes, exactly. So I think that's again a very good thing to happen. Of course, it should not become over-enthusiastic in the sense that, the valuation should not go sky high and then fall later on. But definitely we are seeing more interest from the retail and HNIs, and that's a good thing.
Right. We spoke about consumer durable earlier where you said that, valuations are full, and it's not only true for that, but for the markets. Do you think that traditional FMCG names like HUL, ITC, Godrej, which used to be the favorites earlier, now that traditional FMCG valuations have not gone up much, so now they have started to look attractive versus these durable names?
Well, they are also pretty fully valued. Most of them are between 35 and 50 times FY19. So, well, in comparative terms, maybe they haven't gone up as much, but then they had gone up much earlier. They were already expensive. So, I don't think as an investor you should follow a round robin sort of valuation measure. Saying that, okay, now because this has gone up, so the other thing should go up, and then because that sector has gone up, then the other should go up. Because that can lead to serious mistakes for an investor. So that's like chasing a stock or chasing the market. That never pays in the long term. So you have to look at fair valuations. You have to look at what sort of growth is there, what are the prospects, and value a company or a sector accordingly, and not just because some other sector or other company's valuations have gone up comparatively.
Right, but that's generally the shifting that also happens in a bull market. So when you start to see this sort of moves coming in, it means that flow is trying to chase ideas which are just attractive at this point of time.
It just means that there's too much liquidity in the markets, and that liquidity is chasing those stocks. As a prudent investor, you should be careful at such times.
Right. What will be your call on auto? Where do you think auto is right now? Do you think after GST, once the changes or clarity comes in as to how autos would be charged on an indirect tax basis, do you think auto names would do well, whether it's two-wheelers or four-wheelers?
Autos have already been doing pretty well, particularly the four-wheelers have been doing well. Two-wheelers had been suffering because of a slowdown in demand in the rural sector. So I don't think the GST is going to have much of an impact as far as the auto sector is concerned. But what is really important there is a pickup in demand in the rural sector, particularly for two-wheelers and farm equipment. And I think if you have a good monsoon, definitely there is good potential as far as the two-wheelers are concerned. Passenger car company, there is actually only one, and that's already been doing pretty well.
All right, and as we speak, we've seen the markets perk up quite a bit. In fact, the Sensex has hit a new record high, 30,680. So the Sensex is looking really strong with gains about 250 points or so. Mr. Kapoor, what you're saying liquidity is chasing those stocks where the growth visibility is good. Where else do you think growth visibility is good, where valuations offer some sort of comfort? Do you think housing finance could be one? Could it be tractors and seed companies? What would you look to invest from here on?
Well, yes, there are some. I think one has to look at this on a stock-specific basis. There will be some stocks in different sectors which probably are not as expensive given what their growth prospects are. And on an overall basis also, it depends on what sort of a time horizon you're talking of. Say if you're talking of a 3 to 5 year time horizon, probably, the markets may still not be too expensive. But if you're talking of a 6 month to 1 year time horizon, they are probably more expensive. So, when markets reach such levels, as we are saying, say 20 times prospective earnings, the risk return ratio becomes a little bit unfavorable or less favorable. And the return which you get from these levels is definitely lower than what you would have got when the valuations were lower. That's the only point which I think one needs to take into account. So from these levels, it'd be difficult to get, for example, a 20% per annum return. But say when the index was 1,000 points lower, that was possible. Now from current levels, you would have to moderate your expectations of return. That's That's only the key point.
Right, but that's for the index. I'm talking about stocks and sectors. Mr. Kapoor, do you think some stocks have still not moved up and at the current moment may not have a lot of growth visibility, but maybe after a few months the picture could be different? Could you identify any stocks or sectors where there is a potential of better growth visibility where valuations haven't moved up?
Yeah, so I wouldn't identify stocks, but there could be some sectors like infrastructure, for example, where I think interest rates have been have come down, and therefore and the government is doing a lot of improvements as far as the regulatory environment is concerned. So some of the infrastructure sectors stocks could do well, but on a general basis, there are very few sectors now where valuations are not expensive.
Right. Valuations are not very expensive for IT and pharma stocks also, but there the growth picture is very muddied. What would you do about these stocks?
So I think these will remain as underperformers in the market. Both the sectors you mentioned are suffering from their own problems. Some of them are self-inflicted problems, I would call them. For example, in pharma, as we've seen, this FDA problem is partly self-inflicted. Companies have, not really kept up to what the FDA requirements are in terms of such simple things as cleanliness of the factory, or keeping medicines and drugs in the environment that they should be kept. So some are self-inflicted, they need to correct those. Some of them, of course, are problems created by either regulation or things like that. For example, increasing price control in domestic drug market. In the IT sector, there are very different problems in terms of rupee appreciation, in terms of the whole model changing. The cloud, digitization, there's so many issues. So I think these two sectors will take some time before they start to show better performance again. And the market has clearly reflected that by giving them lower valuations. Of course, at some point of time, the valuations will start to look attractive. But I think particularly in the IT sector, there could be some more pain before that happens.
So you would not look to invest in any of them now? Or maybe if there is a 5 to 10% correction more, would you then accumulate them?
I think that I would still be underweight these two sectors and wait for some more time, watch what is happening, and maybe particularly pharma, look at investing another 5 to 10% cheaper than what they are right now. IT sector, I think one needs to wait some more time, and there also I think even after that there will be only a very few select players who would be worth investing in, and not the entire sector as earlier.
Right. What about some of the stocks in sectors like power and telecom? Do you think they offer good investment opportunity?
Telecom again is going through a lot of turmoil, as we all know, and we know the reasons for that. There is a lot of price war going on, price cutting going on, and while the overall prospects of the telecom sector of course are very good, particularly in data and internet, etc. But I think one has to wait till the worst of this price war gets over. Unfortunately, in some of the companies, yes, stock prices have fallen to reflect this. In some other companies, they have not fallen, and therefore still look pretty expensive. So that's another sector where I would think that one needs to be underweight for maybe another 6 to 12 months before you start looking at that sector.
And what about the power space? Do you think there's an opportunity there now that if demand picks up, capacities will be better utilized? Would you look at the power space more favorably?
Yeah, power, as I said, infrastructure looks pretty good, and in power generation sector, of course, again, it depends on what type of company we are talking about. There are companies which have fixed PPAs, There are companies which have captive coal. There are companies which are selling on merchant basis. There are companies which have got imported coal as their fuel. So I think that's a place where you need to look selectively on a company-wise basis rather than on a sector as a whole.
All right, Mr. Kapoor, thank you so much for speaking with us on NDTV Profit and sharing with us your views on the markets, fund flows and sectors that you like. Pleasure having you with us on the show.